Here on set with us is Danny Moses, the founder of Moses Ventures. It's good to see you.
Thanks for having me.
Another, I'll just say a highly followed D.C. economist made the exact same point this morning, saying to the president, just be careful that you don't push the Fed too far to end up with the very inflation problem that you don't want to have. So it sounds like you see that very similarly.
I see it, and I think the reason you would cut rates is important. Are you going to cut rates because the economy is slowing? Or you can cut rates because inflation keeps coming down. If you do it because the economy is slowing, it could be dangerous here. So
wouldn't it be the right reason to do it? I mean,
well, the right reason to do it, but if inflation hasn't ebbed yet, you definitely are in a pickle here where you could see inflation reaccelerate.
Is the economy slowing?
I think it is slowing at the margin. I think it's still holding up relatively well. We saw the jobs number last week, which was fine, a couple revisions lower to previous months. But things do feel like they're teetering, and we're one bad tariff announcement away, I think, from sending consumer confidence back down again. And I think the wealth effect has a huge impact on.
Is it slowing enough to cut rates? Because we cut them. So. Well, we cut them last year when we were told things were great.
Well, rates were extremely high.
Okay.
So I think we knew the neutral rate. We were a little bit high there, so I think there was room to cut. I understand the argument that you can cut now 25 basis points and wait and see what happens. I totally get that. I just think that Powell's upset that the White House kind of ruined his soft landing temporarily, and they just want to be careful and make sure they do the right thing here. So.
Where are you on the market broadly? Are you in the kind of it's all going to be fine and kind of move higher camp, or in the overvalued camp?
I think we're overvalued, but that's never a good reason necessarily to sell the market. I'm more interested in the sectors within the market and what they look like. And there's too few stocks controlling the market, just like there's too few citizens controlling the economy, in my opinion. So
you're not wrong about that.
Yeah.
I mean, something we've talked about a lot. And not only is it the same 10 stocks that run the show, but the other, if somebody said to me, what's the biggest reason to be bullish on the stock market? There's one very simple reason, and it's just freaking math.
Yep.
The number of stocks that are publicly traded in America has declined by 50% since I started doing this job. It's gone from 8,000 to under 4,000. And there's more people in the world with more money investing in the stock market. So why wouldn't stocks go up?
Listen, flows keep coming into the market. Even in April, you saw flows come into ETFs. Didn't stop. So you're right. It's supply and demand to a degree. But I think within that, right, you're relying on too few companies that are providing most of the earnings for the S&P. At some point, secular becomes cyclical, and you need to find a place to put your money.
Although today is an interesting example. You have Apple, one of the biggest, probably top three of market cap, moving lower. The rest of the NASDAQ's moving higher. The rest of the market's holding up okay. So it doesn't feel like, there's too few companies in control. There's probably a dominant narrative with the AI right now in control.
For sure. There's new announcements every day. And I think the CapEx cycle, every day we go by, proves to be more real in terms of AI and the spend that's going to be occurring. So it's hard to fight that CapEx cycle for sure.
So that's not the area that you're necessarily worried about?
No, I'm not shorting any of those companies per se, but I do believe that will be a reason at some point they're just too expensive and or too concentrated. You got to move it around.
Your point is well taken, because I saw something, and I know the internet's going to at me on this because I was flying all weekend. I was in Texas. I'm back. The equal weighted S&P 500, the one that's not weighted to the NVIDIAs and the Amazons of the world, is at like a multi-year low.
Yeah.
Like it hasn't done well. If you put your money in the S&P 490, you've made no money.
Correct. Well, I think of it this way. If you're a portfolio manager, an active manager, you get paid on beating the passive ETFs, right? That's your goal. So you have to pick a sector and then overweight a certain sector and overweight stocks within that sector. So until proven wrong, it's a catch-22. And what'll happen will be, I believe, as money comes out, it goes to try to find a different home. Those are the stocks and sectors that I'm looking at here.
But just quickly before we go, you like energy. Not many people come on and say, I like energy.
Right. It's not sexy, right?
Not even.
Hey!
It's been terribly underperformed.
Pretty sexy. Yeah. I think energy is, people who cover energy are sexy.
Very, very, exactly.
Price of crude, everyone goes, the administration wants it lower. Why be bullish on energy stocks?
Think about the weighting in the S&P and energy. It's 3% right now. Historically, it's been 7%.
Crazy.
So it won't take a lot just to turn it. So I don't see that going much lower. Price of oil is a little bit disconnected from the value of these energy stocks. These energy stocks in the last 4 to 5 years have gone through transformational M&A. Their balance sheets are in much better shape. No one's going to tell them to drill, baby, drill when they don't want to. As a matter of fact, look at rig counts. They're at a 4 to 5 year low right now. So it's much more economic, makes much more economic sense to own these stocks here. And ExxonMobil, to me, cheap name relatively, I think, to its growth rate, pays a nice dividend, buys back stocks. Same with Diamondback, Energy, Fang there as well. So those are the two names I own.
Are the dividends at risk?